This weekend brought a wave of chaos to the Persian Gulf, sending global oil prices surging nearly 6% as U.S. Iran tensions boiled over once again. The U.S. Navy seized an Iranian vessel in the vital Strait of Hormuz, reportedly disabling its engine room and prompting a sharp Iranian counter-response. In retaliation, Tehran closed the crucial Strait of Hormuz waterway that carries roughly one-fifth of the world's oil, bringing traffic almost to a standstill. Analysts at Citi estimate that roughly 400 million barrels of global oil supply have been lost due to the recent disruption in shipping lanes. The temporary U.S. Iran ceasefire agreement is set to expire on Tuesday night, thereby adding significant pressure to high-stakes diplomatic negotiations in Islamabad, Pakistan. President Trump dispatched a high-level delegation featuring Vice President Vance along with special envoys to these talks, yet Iran's attendance remains far from certain. Reports indicate that hardline IRGC Commander Ahmad Vahiti and his inner circle may now hold real sway over Iran's military decisions and negotiation tactics. Vahiti stands out as a super-hardliner with a long history of staunch anti-American positions and close ties to the Islamic Revolutionary Guard Corps. As former Quds Force commander and defense minister, he is known for cold-hearted resolve forged in the Iran-Iraq war and unwavering ideological commitment. He is subject to sanctions from the United States at this critical moment when negotiations are supposed to restart. Promoting such a figure appears to signal Tehran's resolve to maintain a tough, uncompromising stance. Iranian authorities have publicly voiced serious doubts about any real prospects for success in the Islamabad talks and have denied dispatching their own representatives. President Trump struck a firm, hardline stance in interviews, refusing to lift the blockade or extend the ceasefire without a favorable, comprehensive deal. He has repeatedly threatened to destroy every power plant and bridge inside Iran if the negotiations fail to deliver a satisfactory agreement soon. Surprisingly, despite the weekend's sharp escalation and strong rhetoric from both sides, markets on Monday saw oil surge, while equities posted only modest declines. Brent crude oil prices surged roughly 5% on Monday to trade near $95 per barrel, partially reversing Friday's dramatic plunge. The VIX Volatility Index rose above 19, but gold prices pulled back after their recent run-up, reflecting a market that seems somewhat desensitized to the drama. Investors appear to have developed some immunity to President Trump's characteristic weekend tough talk, followed by relatively contained market moves on Monday morning. With midterm elections looming and recent polls showing Trump's approval ratings at new lows, even among core supporters, the political backdrop adds another layer of uncertainty. Observers question whether mounting domestic pressure could lead the administration to pursue bold or even unpredictable strategies to bolster support before the vote. The critical ceasefire deadline has now arrived, placing immediate focus on whether diplomacy will prevail or if further conflict will intensify in the region. These developments carry massive implications for energy markets, global supply chains, and broader financial stability in the weeks and months to come. To fully grasp the potential impact on portfolios and trading strategies, we now turn to integrate these events with the latest investment research findings and forecasts. But the investment research report connects these threads, showing how Vahiti's iron grip on Iran's military and talks will lock in that 400 million barrel oil supply collapse for weeks. Tehran's elevation of this sanctioned terrorist-linked hardliner right before Islamabad talks exposes the deadly hypocrisy of pretending diplomacy still has a chance. The report's Citi analysts confirm the strait has permanently lost its reliability as a choke point, meaning long-run oil prices must now settle substantially higher regardless of weekend bluster. Kuwait's force majeure declaration in the research brief proves the two-month conflict has already filled Gulf storage tanks, leaving shippers unable to deliver even after reopening. Yet markets reacted with curious calm to Trump's destroy every bridge threats. Brent only surged 5%, while stocks slipped just 0.5% as if numb to the danger. This immunity to weekend tough talk reveals a dangerous complacency that the report warns could shatter once the Tuesday ceasefire deadline expires without progress. Vahiti's cold-hearted IRGC, the research highlights how energy price shocks from this exact scenario already battered the economy in March, forcing Citi to flag a potentially hawkish tilt from Warsh at tomorrow's hearing. Trump's approval ratings hitting new lows even on friendly Fox polls create the hidden incentive for unpredictable escalations that could jolt oil markets. Trump's approval ratings hitting new lows even on friendly Fox polls create the hidden incentive for unpredictable escalations that could jolt oil markets far beyond current pricing. Corporate earnings beat rates holding at 81% look impressive on paper, but the report notes energy firms alone are masking broader industrial pain from freight and insurance spikes. Gold's quick pullback after Friday's surge and the VIX creeping above 19 betray investors betting on swift resolution despite Tehran's denial of sending any real envoys. The transcript lays bare Iran's degraded overseas networks yet still lethal intent, exposing the folly of assuming domestic threats like that California arms broker case remain isolated. Citi's macro strategists in the document spell out the legacy: more inflation, more fiscal spending, steeper yield curves, and higher term premiums, rewarding only oil-linked equities for now. Energy Secretary Wright's warning of $3 gas persisting into next year clashes openly with Treasury optimism, revealing the administration's own fractured messaging on this crisis. Trump's delegation of Vance, Kushner, and Witkoff looks like serious symmetry on television, but the IRGC commander's dominance turns those talks into pure theater for domestic consumption. The report's base case still sees upward pressure on U.S. stocks, yet urges immediate hedges through USO calls or spreads, precisely because this hardliner signal changes the entire equation. Preliminary PMI data due later this week will deliver the first real test of how the energy shock is already hammering business activity across America and Europe. New Zealand's CPI print tonight becomes the global canary in the coal mine, reflecting higher oil costs that the investment brief says will ripple through every major economy. With the Fed confirmation hearing looming, investors must watch whether Warsh commits to rate cuts or digs in hawkish against the very inflation this Persian Gulf chaos is fueling. The research underscores that physical oil flows remain choked by longer voyages and skyrocketing insurance costs, a reality markets seem strangely eager to price out today. Trump's midterm desperation paired with Vahiti's unyielding ideology creates a toxic brew where political survival might trump sound strategy in ways no Wall Street model anticipates. Even the 81% earnings, and that is exactly why the coming days will expose whether Washington and Tehran are truly negotiating peace or simply staging a dangerous election year spectacle for their respective audiences. Yet beneath this dangerous election year, markets may have shrugged off Monday's limited moves, but the report leaves no doubt that physical supply constraints and soaring insurance costs will sustain elevated energy prices well into next year. With Trump's approval ratings hitting new lows, earnings show an impressive 81% beat rate. For now, yet the investment brief highlights how surging energy costs are quietly masking pain in consumer and industrial sectors. Tonight's New Zealand CPI print will serve as the first major inflation data point to fully capture the global impact of these higher oil prices from the Iran crisis. Citi strategists correctly predict steeper yield curves and rising term premiums as the conflict's legacy brings both more inflation and greater fiscal spending demands on governments worldwide. Prudent investors should follow the report's explicit advice by considering USO oil calls or spreads as the most direct hedge against further escalation risks in the Persian Gulf. The relative calm in equities on Monday may prove to be a dangerous illusion once the ceasefire deadline passes without resolution and supply disruptions intensify dramatically. Vahiti's elevation as the dominant hardliner guarantees Tehran will show zero flexibility in talks, preferring prolonged confrontation over any perceived weakness at the negotiating table. This means American families can expect $3 gas prices to persist deep into next year, exactly as Energy Secretary Wright warned, despite conflicting optimism from the Treasury Department. The toxic combination of IRGC ideological control, Iranian hardliner signals, and desperate American domestic politics creates market volatility far beyond anything Wall Street models currently anticipate. Preliminary PMI data later this week will deliver the first hard evidence of how this energy shock is already hammering business activity throughout the United States and Europe. Gold's pullback and the modest VIX rise reveal that too many traders are still betting on swift diplomatic breakthroughs, despite Tehran's clear signals of uncompromising resistance. The research report's base case for stocks could collapse quickly if the Strait of Hormuz stays unreliable and emergency oil reserve releases prove insufficient to restore confidence. In the final analysis, this crisis demonstrates how geopolitical hardliners and electoral calculations are now dictating the future direction of global energy markets for years ahead. The strong earnings beat rate will offer little protection if oil-linked names become the only winners while broader indices buckle under renewed geopolitical and inflationary pressures. As the ceasefire clock expires, one brutal fact stands out: the era of reliable, cheap oil from the Persian Gulf has ended, regardless of short-term diplomatic theater. Trump talks destruction of Iranian infrastructure, yet his administration's contradictory messages expose deep divisions over how far to push against this new super-hardliner in command. For everyday Americans watching their portfolios and gas receipts, the central question remains whether political survival will trump genuine efforts to secure energy stability and lower prices. The investment research leaves investors with clear guidance favoring shorter duration bonds along with targeted oil equities until real clarity finally emerges from the chaos. This weekend's events serve as a powerful wake-up call that markets ignore geopolitical reality at their peril until the full consequences can no longer be denied. Citizens deserve straight talk about these risks rather than partisan posturing that prioritizes midterm optics over the economic security of working families across the country. Stay alert in the days ahead, because only those who grasp the warnings in this report will navigate the gathering storm while others pay a steep price for complacency.